Hello everyone. My name is Ali, and I will be guiding you through this presentation. In this presentation, I will try to enhance your understanding of the fundamental difference between conventional and Islamic banking practices. Prior to getting more into the distinction between a conventional and Islamic bank, we need be aware of what a bank is. Here is the meaning of bank. A bank is a financial institution that accepts deposits from the public and creates a demand deposit while simultaneously making loans, mobilizing saver surplus to deficit spenders. Lending activities can be directly performed by the bank or indirectly through capital markets. Following that, we'll shift our attention to Malaysian Islamic banking. There are a few banks in Malaysia that provide an Islamic banking system. For instance, we have Bank Islam and RHB Islamic. Following that, we'll shift our attention to Malaysian conventional banking. In Malaysia, we have HSBC and Standard Chartered as conventional banks. Now, we are going to explore the fundamental principles of Islamic banks in Malaysia. The first principles of Islamic banking is prohibition of riba. In Islamic finance, the prohibition of riba is a core principle derived from the Quran and Sunnah, the teachings and practices of Prophet Muhammad. Riba, literally meaning increase or excess, is generally interpreted as any predetermined or fixed return on a loan or debt. This prohibition is rooted in the belief that money should not be allowed to generate money by itself, and that financial transactions should be based on fairness, equity, and shared risk. This is a representation of the prohibition of riba. A young man named Abu walked into the bank with the hope of receiving a loan to launch his business.
Excuse me, I'm interested in taking out a loan. But I have a question about interest.
Yes, of course. What's your question?
I understand that banks charge interest on loans. Is that something you do here?
Yes, we do. It's a standard practice in the banking industry.
I see. But I'm concerned about interest. I'm a Muslim and I don't want to engage in any transactions that are forbidden in Islam.
Our interest rates are regulated by the government.
I understand. But I'm still not comfortable with it. Is there any way I can get a loan without having to pay interest?
I understand your concern. Unfortunately, we don't offer any interest-free loans. However, we do have a few Islamic banking options that you might be interested in.
That sounds perfect. Can you tell me more about it?
Certainly. We offer a variety of Islamic banking products, such as Mudarabah and Murabaha. These products are designed to be Sharia compliant and avoid riba.
Ali feels relieved. He knows that there are options available to him that are both financially sound and ethically sound. He is excited to learn more about Islamic banking and to start his business in a way that is consistent with his values. Second principles of Islamic bank is avoidance of gharar. In Islamic finance, the avoidance of gharar is a fundamental principle. Gharar is an Arabic term that encompasses concepts of uncertainty, risk, speculation, and deception within contractual agreements. It refers to any element in a contract where critical information is unknown or ambiguous to one or more parties involved, potentially leading to disputes, injustice, or the transfer of wealth based on chance rather than legitimate exchange. In Islamic finance, the concept of gharar plays a crucial role. It refers to uncertainty, risk, and deception in a transaction. While some level of risk is inherent in any business venture, gharar is specifically prohibited in Islamic law. Next, we will look into an example of the avoidance of gharar. A customer enters a bank and approaches a teller.
I'd like to open a fixed deposit account.
Certainly, sir. Here's the agreement. You'll deposit a certain amount, and we'll guarantee you a fixed interest rate at the end of the term.
But what if the bank faces financial difficulties? Is my investment secure?
Well, we can't guarantee anything, but we're a reputable bank.
This scenario highlights a potential element of gharar. The customer is uncertain about the bank's ability to fulfill its promise, especially in times of economic instability. Next, we will look into Islamic banking. A customer enters an Islamic bank and approaches a representative.
I'd like to invest in a Mudarabah fund.
Certainly, sir. In Mudarabah, you invest your capital, and the bank manages it. Profits are shared according to a predetermined ratio, while losses are borne by both parties based on their investment.
I understand. So, my investment is directly linked to the fund's performance. Yes, sir. Transparency and risk-sharing are key principles in Islamic finance.
This scenario exemplifies how Islamic finance mitigates gharar. The customer is aware of the risks involved and participates in the investment decision-making process. The last principles of Islamic banking is ethical wealth redistribution. Zakat, an obligatory Islamic practice, promotes ethical wealth redistribution. It requires affluent Muslims to donate a portion of their eligible wealth to designated beneficiaries, primarily the needy. This system aims to purify wealth, mitigate economic inequality, and foster social well-being by circulating resources within the community. Here's an example of wealth redistribution, zakat. Aisha, a young, ambitious entrepreneur struggling to launch her small business. Aisha confides in a friend about her financial worries, expressing frustration and self-doubt. Her friend suggests exploring zakat as a potential source of support. Even though Aisha initially hesitated, concerned about pride and self-reliance, Imam Ali gently explains the concept of zakat, its religious and social significance. He emphasizes that zakat is not charity, but a religious obligation, a form of wealth purification. Aisha begins to understand the ethical framework of zakat, recognizing it as a means of supporting community development. Aisha receives a small zakat loan, a crucial boost for her business. She works diligently, her confidence growing with each successful venture. To conclude, zakat is more than just an act of charity, it's an investment in the future. It's about building a society where everyone has the opportunity to thrive, where dignity and compassion are at the heart of our interactions. Let us all strive to fulfill our zakat obligations, to be instruments of positive change in the world. Next, we move to principles of conventional bank. Interest-based system. An interest-based system, prevalent in conventional finance, is characterized by the charging and payment of interest on borrowed or lent capital. This interest represents a predetermined fee for the use of money over a specific period, typically expressed as an annual percentage. However, this system has been subject to criticism, particularly within certain religious and ethical frameworks, due to concerns about potential exploitation, usury, and the widening of wealth inequality. The second principles of conventional bank is focusing on the creditor-debtor relationship. Within an interest-based system, the creditor-debtor relationship is paramount, defining the core dynamic of financial transactions. This relationship establishes a legally binding agreement where the creditor, possessing surplus capital, provides funds to the debtor, who requires capital for various purposes such as investment, consumption, or business operations. This relationship establishes a legally binding agreement where the creditor, possessing surplus capital, provides funds to the debtor, who requires capital for various purposes such as investment, consumption, or business operations. In essence, it's a mutually beneficial exchange where the debtor gains access to necessary capital, while the creditor earns a return on their investment in the form of interest. The last principles of conventional banking is guarantees all deposits regardless of outcomes. A full deposit guarantee system provides depositors with absolute assurance of fund protection against any loss, regardless of the financial institution's condition. This commitment ensures complete reimbursement, even during insolvency or crises, aiming to strengthen public confidence, prevent bank runs, and maintain financial stability, ultimately contributing to a more stable and resilient financial system by mitigating systemic risks and fostering greater trust in the banking sector. Now we will go to ethical and professional conduct of Islamic banking. First, promotes fairness, risk sharing and equity. Second, prioritizes social justice by redistributing wealth through zakat. Third, encourages ethical investments aligned with community well-being. Next is ethical and professional conduct of conventional banking. First, focuses on individual profit, and often prioritizing shareholders over community. Second, practices like compounding interest and penalties for defaulters may result in economic disparities. Moving on, we'll discuss about Islamic banking practices in Malaysia. Mudarabah. Profit-sharing accounts where banks and depositors share profits based on pre-agreed ratios. Murabaha. Cost-plus financing for home loans, avoiding direct lending with interest. Ijara Thumabay. Leasing and subsequent purchase agreements. Bayalina. Sell and buyback transactions. Next we will discuss about conventional banking practices in Malaysia. First, fixed interest loans for housing and personal loans. Second, credit cards with compounding interest. Third, penalties and fines for late repayments. Both systems have their own advantages and disadvantages. Islamic banking is often praised for its ethical and socially responsible approach, while conventional banking is widely accessible and offers a wider range of products and services. The choice between the two systems ultimately depends on individual values, beliefs, and financial goals. As the global financial landscape evolves, it is crucial to foster understanding and respect for both systems, recognizing their respective strengths and limitations.